Gold is supposed to rise when the world looks unstable. That is what most people believe. War breaks out. Oil jumps. Inflation fears return. Investors panic, and gold, the oldest safe haven in financial history, should move higher. But sometimes the market does something colder. It punishes the obvious trade first. It takes the people who were right for the wrong reason, and it makes them question everything. That is the paradox unfolding now. Gold and silver can fall while the world becomes more fragile. Not because the safe haven thesis is dead. Not because the crisis is fake. And not because the market suddenly trusts paper money again. They can fall because the first phase of a crisis is not about safety. It is about liquidity. It is about forced selling. It is about yields. It is about the dollar. And this is where most investors get trapped. They look at the headline and expect gold to move immediately. The contrarian looks at the plumbing underneath the headline, because the market does not reward people for noticing fear. It rewards people for understanding the mechanism. This is not a crash. This is a setup. Right now, the metals market is sending a message that feels contradictory. Gold has pulled back from strength. Silver has been even more volatile. Mining stocks have not behaved the way retail investors expected. And at the same time, the macro environment has not become calm. It has become more complicated. There are geopolitical tensions. Energy prices remain a major risk. Governments are still running large deficits. Debt servicing costs are no longer a background detail. Central banks are still trying to balance inflation credibility against economic weakness. And investors are trapped between two fears. The fear of inflation and the fear of recession. That combination is dangerous because it creates confusion. If inflation is the problem, investors expect hard assets to rise. If recession is the problem, investors expect cash and bonds to outperform. If both are possible, the market starts to behave in ways that appear irrational. But it is not irrational. It is mechanical. When a shock hits the system, the first reaction is rarely thoughtful. Institutions do not sit around calmly discussing the philosophy of money. They reduce risk. They raise cash. They protect balance sheets. They sell what they can sell, not always what they want to sell. Gold is liquid. Silver is liquid. Mining stocks are liquid enough to be sold quickly. That means they can get hit even when the long-term argument for owning them improves. This is the first hidden truth. Good assets can fall for bad reasons, and bad reasons can create good entry points. The average investor sees red candles and assumes the thesis is broken. The contrarian asks a different question. Who is selling? Why are they selling? And what happens when they are finished? Most people have a simple model for gold. Crisis equals gold up. Money printing equals gold up. Inflation equals gold up. Dollar weakness equals gold up. And in the very long run, parts of that model can be true. But the timing is where people lose money. The mainstream narrative says gold and silver should act like emergency insurance. The moment there is geopolitical stress, they should move higher. The moment oil prices rise, they should protect purchasing power. The moment the financial system looks unstable, they should become the obvious refuge. That story is clean. It is also incomplete. Because gold is not just a fear asset. Gold is also a duration asset. Gold competes with cash, bonds, and the dollar. Gold has no coupon. It pays no dividend. It does not distribute earnings. It simply exists as a form of monetary insurance. That means when real yields rise, gold often struggles. When the dollar strengthens, gold can struggle. When institutions need liquidity, gold can be sold even if the world is becoming more dangerous. This is where the crowd gets blindsided. They hear about war, inflation, or political instability, and they assume gold must immediately explode higher. But markets do not pay investors for having the obvious emotional reaction. They pay investors for seeing the second-order effect. The first-order effect is fear. The second-order effect is policy. The third-order effect is liquidity. And the fourth-order effect is positioning. By the time retail investors understand the fourth layer, the move is usually already happening. The mainstream view fails because it treats gold like a headline detector. It is not. Gold does not simply respond to fear. Gold responds to the price of money. That may be the most important line in this entire script. Gold does not respond to fear. It responds to the price of money. Imagine a major geopolitical shock. The first thing markets do is look at energy. If oil supply is threatened, oil prices rise. If oil rises enough, inflation expectations rise. Not actual inflation immediately, expectation. And expectations matter because central banks react to them. If inflation expectations are moving higher, the Federal Reserve has less room to cut rates. Even if the economy is slowing, the Fed cannot appear soft on inflation, so the market begins to price in higher for longer rates. Then bond yields rise, and suddenly investors can earn a return on government debt. Gold, meanwhile, still yields nothing. That creates pressure. Then comes the dollar. When global investors become afraid, many still run toward the US dollar and US Treasury market. Foreign investors need dollars to buy those assets. That demand can push the dollar higher. Gold is priced in dollars. So a stronger dollar can make gold more expensive for foreign buyers and pressure the metal in the short term. Now combine all of that. Higher oil, higher inflation expectations, a Fed that cannot easily cut, higher bond yields, a stronger dollar, forced selling, profit-taking, liquidity stress. That is how gold can fall during a crisis. Not because gold is useless, but because the first phase of a crisis often rewards cash. The second phase rewards patience. And the third phase rewards structure. This is why the average investor sells at exactly the wrong moment. They bought gold for protection. Then the protection falls. They feel betrayed. They assume the thesis failed. They sell. But the thesis may not have failed. The market may simply be moving through the ugly part of the sequence. This is not about predicting tomorrow morning's candle. It is about understanding the cycle. To understand gold and silver, you have to stop thinking like a headline reader and start thinking like a balance sheet. Every major shock has layers. The 1970s were not just about gold rising. They were about a complete breakdown in confidence after the end of the Bretton Woods system, oil embargoes, inflation, and policy credibility problem. Gold did not rise in a straight line. It shook people out. It corrected. It tested conviction. But over the decade, the monetary regime changed, and gold became a refuge against that change. The late 1970s brought another oil shock. Inflation psychology became embedded. Investors began to understand that the problem was not one headline. It was the structure of money, energy, and policy. Then came 2008. This is one of the most important examples because it destroys the simple safe haven myth. During the financial crisis, gold did not just go up every day because banks were failing. There were moments when gold was sold because investors needed cash. Funds were deleveraging. Margin calls were everywhere. In a liquidation, almost everything can be sold. But after the forced selling, the policy response arrived. Rates collapsed. Central banks expanded balance sheets. Trust in the financial system was damaged. And gold eventually entered a powerful move higher. The first move was liquidity. The second move was policy. The third move was distrust. That sequence matters. The same kind of logic appeared again after major geopolitical events in the early 2000s and after Russia's invasion of Ukraine. Gold often reacts, fades, frustrates late buyers, and then responds more clearly when the macrostructure becomes impossible to ignore. This is the part most people miss. The big money is not always buying the panic candle. The big money often waits for the panic to exhaust itself. Retail investors want confirmation. Contrarians want dislocation. Retail sees a falling price and asks, what is wrong? Contrarians see a falling price and ask, is the structure getting better or worse? That difference is everything. Price is the crowd's emotion. Structure is the market's confession. So what is the structure? Start with debt. Modern governments have built systems that are extremely sensitive to interest rates. When debt levels are high, higher rates do not just slow the economy. They increase the cost of carrying the state itself. This creates a quiet conflict. Central banks may want high rates to control inflation. Governments may not be able to afford high rates forever. Investors understand this conflict. They may not say it directly on television, but they understand it. A system with high debt, persistent deficits, and political pressure does not have unlimited room for tight money. Eventually, something has to give. Either inflation comes down cleanly, growth survives, and the debt burden remains manageable, or the system moves toward financial repression, lower real rates, currency debasement, or some combination of all three. Gold exists for the second scenario, not because it is magical, but because it is no one else's liability. A treasury bond is an asset to the holder, but a liability to the issuer. A bank deposit is an asset to the depositor, but a liability to the bank. Gold is different. It just sits outside the credit system. That is why central banks own it. That is why countries that distrust the dollar system often accumulate it. That is why gold becomes more interesting when trust becomes more expensive. Silver is different. Silver is part monetary metal, part industrial metal. That makes it more volatile. It can behave like a precious metal during monetary stress, but also like a cyclical commodity during economic weakness. This is why silver often frustrates people. It can lag, collapse, explode, and overshoot. Silver is not the calm older brother. Silver is the unstable cousin with leverage. When the gold thesis is right, silver can amplify it. When liquidity is tight, silver can punish impatient buyers. This is why timing matters. And then there are the miners. Miners are not gold. They are businesses. They have costs. They have management teams. They have jurisdictions. They have balance sheets. They have operational risks. They can underperform the metal for long periods. But when the setup is right, miners can act like leveraged exposure to gold. If a miner's cost of production is relatively fixed and the gold price rises, margins can expand much faster than the metal itself. That is the attraction. It is also the danger. A gold bar cannot mismanage a mine. A mining CEO can. A royalty or streaming company has a different model. Instead of digging the metal out of the ground, it finances miners and receives a share of future production or revenue. That can reduce some operational risk, but it still carries valuation risk, commodity risk, and counterparty risk. So the contrarian does not simply say, buy miners. The contrarian says, understand the instrument. Gold is monetary insurance. Silver is volatile monetary industrial optionality. Miners are operating leverage. Royalty companies are structured exposure. They are not the same trade. They only look the same to people who have not done the work. The real signal is not the headline. It is not the television debate. It is not a price target. It is not someone screaming that gold is finished or that silver is about to explode. The real signal is the difference between price and structure. Price can fall while structure improves. That is where opportunity lives. If gold pulls back because real yields spike temporarily, that is one thing. If gold pulls back while central banks continue diversifying reserves, debt burdens remain heavy, deficits remain unresolved, and policymakers are trapped between inflation and recession, that is another thing entirely. The first is a broken trade. The second may be a better setup. This is where the 200-day moving average becomes useful, but not magical. Institutions watch long-term moving averages because they help define trend, momentum, and positioning. When price moves far below a widely watched long-term average, it can signal stress, exhaustion, or potential reset. But no line on a chart guarantees anything. A moving average is not a prophecy. It is a map of behavior. If gold or silver falls below a major long-term trend level, while the structural thesis remains intact, contrarians pay attention, not because they are certain, because a symmetry may be forming. A bad investor needs certainty. A good investor studies probability. A great investor studies asymmetry. The question is not, will gold go up tomorrow? The question is, what is the market pricing in, and what is it ignoring? Right now, the market often focuses on the short-term headwinds, yields, the dollar, Fed policy, liquidation, but the deeper structural questions remain. Can governments finance themselves comfortably at higher rates? Can central banks cut If inflation expectations rise again, can the dollar system remain unquestioned if more countries diversify reserves? Can silver supply respond quickly if industrial and monetary demand collide? Can miners generate expanding margins if gold stabilizes at elevated levels? These are the questions that matter, not because they give easy answers, because they reveal where the crowd may be too confident. And markets are most dangerous when the crowd is confident about the wrong thing. So when gold and silver fall during a crisis, do not automatically assume the thesis is dead. Ask what phase of the cycle you are watching. Phase 1 is shock. People expect safe havens to rise immediately. Sometimes they do, but often the first move is chaotic. Phase 2 is liquidity. Institutions sell what they can. The dollar strengthens, yields rise. Gold struggles. Silver gets hit harder. Miners scare everyone. Phase 3 is exhaustion. The panic becomes boring. Headlines move on. Retail investors lose interest. The emotional money leaves. Phase 4 is structure. The deeper forces reassert themselves. Debt still matters. Real yields still matter. Central bank behavior still matters. Currency trust still matters. Supply still matters. And the assets that look broken begin to look different. Not guaranteed, not risk-free, but different. The first move is often a lie. The second move reveals the structure. That is the mindset. Not bullish because a chart is down. Not bearish because a headline is loud. Patient because markets are designed to transfer assets from emotional hands to prepared hands. Most people want the market to make sense immediately. But the market rarely does that. It creates contradiction first. Then it creates pain. Then it creates clarity. By the time clarity arrives, the price has usually moved. That is why the contrarian studies the confusion. Gold falling in a crisis is not automatically a warning. It may be the market's way of clearing the obvious buyers before the real move begins. Silver weakness is not automatically failure. It may be volatility doing what volatility always does. Mining stocks breaking down are not automatically dead money. They may be resetting expectations before margins matter again. But none of this means you chase. None of this means you ignore risk. None of this means you buy something because it fell. Falling prices alone are not value. Value appears when price falls and the underlying structure improves. That is the difference. That is the work. That is the part most investors skip. This channel is called Bury Mindset for a reason. Not because every trade has to be dramatic. Not because every market move is a conspiracy. And not because being contrarian means disagreeing with everything. Real contrarian thinking is quieter than that. It means looking where the crowd refuses to look. It means asking uncomfortable questions. It means separating price from structure. It means understanding that the safest looking consensus can sometimes be the most dangerous place in the market. Gold and silver are not simple assets. They are mirrors. They reflect debt, trust, liquidity, policy, fear, and time. And right now, that mirror is showing something uncomfortable. The system wants lower rates. Inflation may not allow it. Governments want cheap financing. Bond markets may resist it. Investors want safety. But safety is becoming more expensive. That is the real story, not the daily candle, not the panic headline, not the influencer price target. The real story is the structure underneath. So watch the yields. Watch the dollar. Watch central banks. Watch silver's behavior relative to gold. Watch miners, but do not worship them. And above all, watch your own emotions. Because the market does not need to fool everyone. It only needs to fool the impatient. If this helped you think more clearly, subscribe to Bury Mindset. Not for hype. Not for certainty. For independent thinking in a market that rewards very little of it. The crowd reacts to price. The contrarian studies the machine. And sometimes the machine whispers before it moves.